All right, let's get right into it. We're treating this session as a serious, high-level strategy meeting. The date, according to the analysis we're breaking down, is January 2026. And we're not here to talk about fuzzy forecasts or predictions. We're here to conduct an autopsy. An autopsy of the old financial order, because something, somewhere, has fundamentally broken. The mission today is to dissect the mechanics of this new reality and to really debate a radical blueprint for capital survival. Let's begin.
This is the number that breaks the entire machine. $2 trillion. I mean, it's a figure so large it's almost meaningless. Now, this isn't the total debt. This is the annual interest expense on the United States national debt. Not paying down a dime of the principal, just the cost to service our past decisions. This number, it's the singularity everyone's been warning about. It's not just another data point, it's a phase transition. A point where the very physics of finance start to warp and then they completely shatter.
And right here, this is where you see the consequence. Just look at the scale of this. That $2 trillion interest payment, it's not just another line item anymore. It is now the single largest expenditure in the U.S. federal budget. Think about that for a second. We are now spending more money just to service our past debts than we are to defend our future. It's bigger than Social Security. It is bigger than every single dollar we spend on education, infrastructure, and homeland security combined. This isn't a projection. This is the simple math of where we are. This is the event horizon.
So here's our roadmap for today's deep dive. First, we're going to define the crisis itself, what we're calling the event horizon. Then we'll look under the hood at the engine of wealth destruction, the math of decay. After that, we can really start to critically evaluate the proposed escape plan, the anti-fragile blueprint, and stress test it against what we're calling the execution minefield. This is going to lead us to a whole new layer of risk, the end of geography, before we wrap up with the stark choice that every single person managing capital now has to face.
Okay, let's dive into our first section. The sources we're analyzing here borrow a term from physics, and honestly, it's a chillingly perfect metaphor, the mathematical event horizon. You know, in cosmology, that's the boundary around a black hole. It's the point of no return where not even light can escape. Well, in finance, it's the point where the gravity of a country's debt becomes so immense that economic escape velocity is literally mathematically impossible.
And here's the crucial insight. Once you cross this line, the debt starts compounding faster than your underlying economy can possibly grow. You can't tax your way out of it. The rates you'd need would just kill the economy. You can't inflate your way out without destroying the currency itself. The sheer gravity of that compounding interest simply overwhelms any escape velocity from your GDP. And the terrifying argument in our source material isn't that we are approaching this horizon. The argument is that we've already passed it. We are already inside.
Now, the obvious comparison people make is to the stagflation of the 1970s. But that comparison is a really dangerous oversimplification. Let's break down why this is completely different. Back in the 70s, U.S. debt to GDP was around a manageable 30%. Today, you can see it's over 120%. That leverage changes absolutely everything. Back then, we had the Volcker moment. Paul Volcker could jack up interest rates to 20% to crush inflation, and it worked. If we even tried that today with our current debt load, well, the interest expense would explode to over $3.6 trillion a year. It would eat up nearly 80% of all federal tax revenue. It would trigger an immediate sovereign default. That tool is broken. The brake pedal has been ripped right out of the car.
And this brings us to the core reason why traditional portfolios are failing. For 40 years, the classic 60-40 stock and bond portfolio worked because of one simple rule: negative correlation. When stocks went down, your bonds went up. The bonds were your airbag. But in this new world of high debt and sticky inflation, that relationship has flipped. Now, when inflation spikes, stocks fall because costs are rising, and bonds fall because inflation is eating away their value. The seesaw has snapped in half. Both sides are crashing to the ground at the same time. The airbag, it's now full of shrapnel.
So this positive correlation doesn't just break the 60-40 model. It unleashes a hidden corrosive force on every portfolio. This gets us to the mathematical heart of the decay, something called the Volatility Tax. And look, understanding this is no longer some academic exercise for quants. It is the dividing line between those who will preserve capital in this new era and those who are going to watch it just relentlessly evaporate.
So let's be really precise. You don't get to eat your arithmetic returns, you eat your geometric or compounded returns. The arithmetic average is just the simple mean. It's what you see in a marketing brochure. But the geometric return is the actual rate of growth that determines the dollars in your account after you factor in the path of those returns. The gap between those two numbers, that is the volatility tax. It is a hidden, insidious fee you pay for the bumpiness of the ride.
Let's just look at the formula itself because its elegance is absolutely brutal. Your real growth, let's call it GP, is roughly your average return, our average, minus half of your variance. And variance is just volatility squared. That final piece of the equation, that variance divided by 2, that is the tax. It's not a metaphor, it's a mathematical reality. It is a relentless drag on compounding your wealth. The more volatile your portfolio, the higher the tax you pay, period. In the old world, boring bonds reduce this tax. In this new world, they actually increase it.
Okay, let's make this painfully clear with a simple example. You start with $1 million portfolio. In year 1, the market crashes 50%. You're now down to $500,000. In year 2, the market has a fantastic rally. It booms 50%. Now, the average of negative 50 and positive 50 is 0. So the brochure, the arithmetic return, says you broke even. But let's look at your actual bank account. A 50% gain on $500,000 is only $250,000. Your final value is $750,000. That is the volatility tax. $250,000 just vanished from your portfolio, even with a 0% average return. That is the price you paid for variance. This asymmetry is the silent killer in modern portfolios. To get back to even from a 50% loss, you don't need a 50% gain, you need a 100% gain. And with stocks and bonds now moving in the same direction, this invisible bleed is only getting worse.
So if the old model is mathematically broken, what's the alternative? The source material we're looking at proposes a pretty radical portfolio shift, one that's designed not just to survive the chaos, but to actually get stronger from it. They call it the anti-fragile blueprint.
The blueprint rests on 4 main pillars, and each one is designed to counteract a specific failure of the old 60-40 model. First, you shift from public bonds to inflation-hedged private credit. Second, you want direct ownership of hard assets, specifically things like tokenized energy infrastructure, so you own a piece of the real economy. Third, a strategic allocation to a digital bearer asset like Bitcoin. And finally, a really tactical way of using cash called the vortex hedge.
Now, a blueprint is just a theory, and this is where our analysis has to turn into a really rigorous debate. This strategy sounds great on paper, but can a real-world institution actually execute it? We now have to walk through the execution minefield and stress test every single one of these pillars. Because when you're desperate to escape a burning building, you have to be incredibly careful not to leap from the frying pan into a pit of illiquidity and regulatory fire.
Okay, let's start with private credit. The pro case is compelling, right? You're lending directly to companies, often at a floating rate that moves with inflation, which is a great hedge. You're also higher up in the capital stack, so you get paid back before stockholders. On paper, it's the perfect replacement for bonds. But the critics ask a devastating question. What about liquidity? In a true crisis, private credit markets don't just drop, they freeze. There is no bid. Your statement might show a healthy valuation, but your ability to actually get your cash out is 0. You're trapped. Now, the counterargument, and this is key, is that you are consciously trading liquidity for solvency. It's arguably better to be temporarily illiquid in a fundamentally solvent asset that's kicking off cash than to be perfectly liquid in a provably insolvent one, like a long-duration government bond in a hyperinflationary world.
Next up, hard assets and digital assets. The logic here is to own the physical inputs of the new economy, things like data centers, energy infrastructure, or a digital asset with 0 counterparty risk. Seems solid, but this strategy doesn't eliminate risk, it just transforms it. You are swapping market risk for political risk. So you own a tokenized data center. What stops a desperate government that's starving for cash from slapping a massive windfall tax on you, or just using eminent domain to seize it? And if you hold Bitcoin, great, you've eliminated counterparty risk, but you may have just painted a giant target on your back for the state. As the sovereign gets more desperate, it's not going down without a fight. It's going to view independent financial rails as a threat. So you can expect restrictions, aggressive taxes, and maybe even outright hostility. Your hard asset is only as hard as the legal system allows it to.
This quote from the source material just cuts right to the heart of the critique. This blueprint is effectively asking pension funds, endowments, and family offices to start operating like nimble, high-risk hedge funds. It requires a level of active management and risk tolerance that is completely foreign to them. It assumes you can expertly navigate these incredibly complex geopolitical environments. Now, the response from the blueprint's proponents is blunt. The world has changed. The job of an allocator isn't to be a passive collector of fees anymore. The job is now active risk management in a hostile world. The allocator has to become a trader, or they simply will not survive.
And this brings us to what might be the most critical and most overlooked layer of risk management in 2026. The debate is shifting from what you own to where you own it, For decades, Western capital markets were the default safe harbor. That assumption is now being seriously tested. As sovereign states get deeper in debt and more desperate, they inevitably become hunters of domestic capital. The weaponization of finance, something that used to be for foreign policy, is now being turned inward. This is the concept our sources call the end of geography.
So the new alpha is jurisdiction diversification. The strategy involves moving a significant chunk of capital to neutral financial hubs, places like Singapore, Switzerland, Abu Dhabi. What do these places all have in common? Well, for one, they are net creditor nations. Their entire business model is based on the global protection of property rights. Their primary export is stability and the rule of law. They aren't trapped by the same debt problems as the G7. You can think of it like this. They are selling you an insurance policy against your own home government changing the rules of the game overnight. And history shows us with 100% certainty that desperate states always change the rules. They use capital controls, they freeze assets, they create patriotic bond programs, retroactive taxes, you name it. Moving assets to a neutral jurisdiction isn't about tax avoidance. It's about escaping the blast radius of a sovereign debt crisis. Now, it's not easy. It involves complex legal work. But the alternative is to stay 100% exposed to a single country's fiscal policy. And that concentration of risk is no longer being priced correctly.
And this leads us to the most provocative question in this entire analysis. Is your passport, your portfolio's single greatest point of failure? For the vast majority of investors, the answer is, unfortunately, yes. If you live in one country, you earn in its currency, you bank in its system, you own its real estate, and you hold its financial assets, you are not diversified. You are 100% long a single jurisdiction. For the last 75 years, being 100% long the United States has been the greatest trade in history. But in an era of unprecedented sovereign debt, that concentration of risk becomes your single greatest vulnerability. The container itself is leaking. This isn't about being unpatriotic, it's about fiduciary duty. It is about building a lifeboat that is legally and geographically separate from the main ship.
And this brings our entire deep dive right to its conclusion. The choice facing investors today is not between safety and risk. That's gone. The choice now is between two different kinds of existential risk. The old world is over. Now you have to choose your poison. This slide really summarizes the entire argument, the stark choice we all now face. On one side, you have systemic risk. This is the decision to just stick with the status quo. This is a passive bet on a failing system, but it's not a bet on safety. It's a bet on the certainty of loss through that slow mathematical grind of inflation and the volatility tax. It is choosing to be trapped by a desperate sovereign. On the other side, you have execution risk. This is the decision to try the anti-fragile blueprint. It's an active, difficult, uncertain path. It does not offer safety. It offers a probability of survival. But it exposes you directly to the risks of market timing, catastrophic illiquidity, and regulatory backlash. You are basically trading a slow, certain bleed for a high-wire act with no safety. Ultimately, the sources we've analyzed leave us with this final, chilling thought. You can fire a manager who executes poorly. You cannot fire a collapsing currency. The risk of the new blueprint is manageable, even if it's very high. The risk of the old system is terminal. For decades, we were all taught that U.S. government debt was the risk-free asset. But in a world where that debt is mathematically unpayable without profoundly debasing the currency, the risk-free asset has become return-free risk. The event horizon is here. The physics have changed. The only question left is whether you will change with them.